Hi, folks. Today we're going to talk about why diversification matters in property ownership, real estate risk, and strategy explained. Okay, if all of your wealth is concentrated in one property, you may be taking on more risk than you realize. In today's market, smart homeowners and investors aren't just thinking about buying real estate, they're thinking about how to diversify within real estate to protect their future. In this video, I'm going to explain why diversification matters in property ownership, how it reduces risk, and how you can apply it whether you own one home or several homes. Hi, I'm Joe Luca, Realtor with REMAX Preferred, and my focus is helping homeowners and buyers make strategic real estate decisions that create the best possible outcomes, not just today, but long term too. Now, diversification, as you can guess, simply means not putting all your eggs in one basket. In real estate, that can apply in several ways: owning in different types of communities, owning different types of properties, or balancing real estate with other financial assets. Because here's the reality: real estate is very powerful, but it's not risk free. Markets shift, neighborhoods change, expenses come up unexpectedly, and the city of Providence right now is talking about a rent stabilization program, which could adversely affect the value of multifamilies and eventually single families as the tax burden is shifted from the declining value of multifamilies to single families that aren't even rented. So if everything you own is concentrated in one place, those risks become amplified. Let's break down what that risk can look like. So if you own just one property, you're exposed to local market fluctuations. You rely on one source of value or income, and your equity is tied to one location and one property type. For example, if your area experiences declining demand, rising taxes, or economic changes like rent stabilization, your entire real estate position is affected. But when you diversify, you reduce that exposure. Now, here are a few ways homeowners and investors can diversify. One, property type diversification: single family, multifamily, condos, even small commercial properties. Two, geographic diversification: owning property in different towns or even different states. Three, strategy diversification: mixing primary residence, rental properties, or short term investments. And four, equity diversification: not keeping 100% of your wealth tied up in real estate, balancing it with other assets. The goal isn't to complicate things, the goal is to create stability, flexibility, and long term growth. One of the biggest mistakes that I see is homeowners making decisions based on what worked in the past instead of what reduces risk moving forward. Smart real estate strategy isn't about chasing appreciation. Chasing appreciation. It's all about managing risk while positioning yourself for opportunity. That's what diversification does. It gives you options. If you're thinking about buying, selling, or investing and want to understand how diversification fits into your strategy, I'd be happy to help you map that out. Subscribe to this channel for more videos on real estate strategy, market trends, and wealth building through property ownership. And if you found this video helpful, please reach out. Let's put a plan together that works for you, because I'm here for your benefit. Joe Luca, Realtor, and I'll see you in the next video. Bye-bye.